As we begin our coverage of the topic of inventory, I want to start us off with something that I've termed as the inventory equation. It really is basic, and I'm sure you already understand it, but it's going to be a helpful framework for topics we'll be covering throughout this unit. Essentially, it is an expression that equates beginning inventory plus net purchases with cost of goods sold plus ending inventory. Let's first consider the left-hand side of that equation, or beginning inventory plus purchases. This is referred to as goods available for sale, or if we're putting a dollar amount to it, the cost of goods available for sale. In other words, what you started the period with, plus what you added to it via purchases, that amount then must be equal to what you sold during the period plus what you are left with in ending inventory. So here's a quick example for you to work through. Go ahead and pause the video and take 30 seconds to use the provided information to calculate cost of goods sold for the year. Reading through this block of information, we can set up our inventory equation as beginning inventory of 72,000 plus the net purchases during the year of 310 grand. We set this equal to our unknown cost of goods sold plus $65,000 of ending inventory. We then apply some basic algebra, solve for the unknown, and we can get cost of goods sold of $317,000 for the year. Here's another quick one. I won't read it out loud, just go ahead and take this info to calculate now the company's cost of goods available for sale during the year. So there's a couple ways you could think about solving a problem like this. First, you could set up the full equation acknowledging that purchases are the unknown for now, solve for them, and then add it to beginning inventory to get goods available for sale equal to $400,000. But I hope that you might have also noticed we could have solved this even easier by simply remembering that goods available for sale is equal to the goods sold plus ending inventory. In other words, we could have just added these two amounts from the beginning and called it good. So I'll repeat what I said earlier. This equation helpfully illustrates that the amount of inventory that we start the period with, plus what we added to it in purchases, is equal to what we sold during the period, plus what we're left with in ending inventory. The logic here is pretty straightforward and can be helpful conceptually later on, but what's not as easy is just getting these numbers in the first place. For instance, one of the first things we need to determine in the initial measurement of inventory is knowing which costs can be included in its value. And per the language of the codification, we read that all expenditures that are needed to bring inventory to its proper condition and location are included in its cost, meaning the cost amount that will be put on the balance sheet for inventory. So generally, this would include a variety of costs. Most obviously, the original transaction price that you are purchasing the inventory for, but it can also include other expenditures, like the taxes you paid on the goods. This could include both sales taxes, or if you're importing goods from overseas, this might include any duties or tariffs paid. There's also a variety of costs related to the inventory's logistics and transportation. The inbound shipping itself is often referred to as freight in as it's coming to you. But suppose it's sensitive stuff that you're shipping. You might pay for it to be insured or have other special handling procedures. Those costs could also be included. Even things like paying the cost to inspect the quality of inventory once you received it can also typically be included in its cost. And one other thing I'm making note of here is that any purchase discount that you might receive, for example for timely payment, that would reduce the cost of inventory. Alright, so all of these factors we would consider in the cost of our inventory, but generally we would exclude things like any interest paid needed to finance the purchase, any costs to store the inventory, and certainly we need to exclude any expenses associated with the selling of the inventory. For example, advertising it, paying salaries or commissions to salespeople, and shipping it to the customer. Those will not be included in the value of our inventory. So in practice, there could be a variety of costs that are incurred and are related to our inventory, but only those costs that were necessary to get it in the right place and condition to begin selling it are capitalized. And we don't just worry about which cost to include, we also have to determine which units will be included in our final ending inventory. We're going to start by obviously considering goods that are in the company's actual physical possession. But there are other scenarios where the company still has control, or we otherwise make adjustments to include units of inventory that are not physically present with the company. And some of this stuff is simply a review of prior material. For instance, back in our revenue recognition module, we talked about consignment operations, and we said that revenue was not recognized at the time goods are shipped to a consignee. So in a similar spirit, inventory is not considered having truly left the company in an economic sense at that point either. We've also talked about sales returns as a contra revenue account, that we need to reduce revenue for both actual and estimated returns. Likewise, the extent to which we estimate returns will occur, those amounts also serve to reduce our cost of goods sold for the period, and those amounts get added back to our inventory. Lastly, we also need to carefully evaluate and potentially include any goods that are in transit at year end, where we focus not on where the goods are, but who has legal ownership. So let's stick with this topic for a bit longer. Like I mentioned, with goods in transit, the key task here is to identify which party, either the buyer or the seller, has ownership and legal control of the goods, which comes from determining at which point in time title transfers from the one to the other. And this doesn't just relate to when a company sells to its own customers, we also have to consider the amounts being purchased from suppliers. So across a potentially wide variety of suppliers and customers, it's possible for there to be a diversity of arrangements in these purchase contracts. And if these shipping arrangements are not 100% standardized, we'll need to carefully analyze each contract to determine whether the shipping terms are free on board or FOB shipping point versus FOB destination. Hopefully, these terms are familiar to you. They refer to which party has liability for the goods in case they are damaged or lost in transit. In other words, this determines the location where title transfers from seller to buyer. So as a final practice in this video, I want to give you a few scenarios where I want you to think to yourself whether or not goods should be included among a company's inventory at year end. Take, for example, Company A that ships goods to customer B with terms FOB destination on December 31st, 20x1, and they're delivered the next day, which corresponds to the next fiscal year. Should they be included in Company A's 20x1 balance sheet? So think to yourself, pause if necessary, go ahead and put a stake in the ground here. The answer is yes. Even though the goods had left Company A's physical possession before the end of the period, with terms of FOB destination, title had not yet transferred to the buyer as of the balance sheet date. However, had the contract specified terms of FOB shipping point, then these goods would have been properly excluded. Let's try another one. If Company C is now purchasing goods from vendor D, this is done with terms FOB shipping point on December 31st, 20x1, and they are received the next day, January 1st, should we include those units on Company C's 20x1 balance sheet? Again, the answer is yes, because when the goods left the vendor's warehouse on December 31st, that is when title transferred with terms of FOB shipping point. Accordingly, had they shipped with terms FOB destination, then the vendor would have retained title at year end, and these goods would have not been included on Company C's balance sheet. So that's good for now. We're slowly easing our way into considerations relating to the cost and physical units of inventory. You're now hopefully ready for a brief review of cost flow assumptions.